Hey everyone, and welcome back. It's funny how some things never really get old, and today's deep dive is all about proving that point.
I agree.
We're diving into how to invest money, a guide that's over a century old.
A century old.
I
Wow.
know, right? But before you think we've gone completely vintage on you, let me tell you, this book is packed with wisdom that's still surprisingly relevant today.
It's true. The fundamentals haven't changed as much as you might think.
Exactly. So get ready to unearth some timeless principles, learn from the investors of the past, and use those insights to make smarter choices in today's market. Think of it as your financial time machine, helping you navigate the ups and downs of investing, no matter what era you're in.
A financial time machine. I like that.
Right. So where do we even begin with a book this old? Well, it jumps right in, separating the concept of investment from speculation. Why does that even matter 100 years ago or today?
Well, back then, just like now, there was this allure of getting rich quick, the temptation to chase the next big thing. This book, it reminds us that true investing is about understanding the long game. It's about securing your financial future, not gambling it away.
So less Wolf of Wall Street, more Warren Buffett. Got it.
Exactly. And, that leads us to a really important concept they emphasize, pure interest.
Pure interest. Okay.
Now, imagine this. You're getting a return on the world's safest investment.
Okay. Sounds good to me.
It's going to be small.
There's the catch.
Always a catch, right? Anything you earn beyond that pure interest, well, it means someone's taking a cut, think management fees, or you're venturing into riskier territory for potentially higher returns.
So it's a trade-off, risk versus reward. Timeless indeed. Now, this book doesn't just preach principles, it gets into the nitty-gritty. 5 qualities, to be exact, that every investor should consider when evaluating an investment.
They are safety, income, convertibility, appreciation, and stability.
Music to my ears. But for our listeners who aren't fluent in finance speak, break those down for us.
Right, so we're talking about the safety of your initial investment, the interest it earns, how much income you can make from it, how easily you can convert it back to cash when you need it, whether its value will go up over time, and how stable its price is in the market.
Okay, that's a lot to juggle. How do we know which of those qualities are most important?
That's the kicker. The importance of each of these qualities depends entirely on your individual needs and goals. Let me give you an example. Imagine you've got extra cash sitting in your business account. You'll probably prioritize an investment that you can easily convert back into cash when you need it, right? Liquidity is key.
Absolutely. Got to keep those business wheels turning.
Now, let's say you're a long-term investor. You're looking for growth, maybe even thinking about retirement, decades down the road. You might prioritize an investment that has the potential to increase in value over time, even if it means sacrificing some of that easy access to cash in the short term.
So knowing yourself, knowing what you want, it's just as important as knowing what you're buying. I love that.
It's all connected.
This source also tells a pretty powerful story about why diversification is so important. It takes us all the way back to the 1906 San Francisco earthquake. There was this fire insurance company.
Oh,
I know, right? Just setting the scene here.
not good for an insurance company.
Not good at all, especially when you hear that they had most of their assets in, you guessed it, San Francisco real estate.
Oh, wow.
Yeah, not exactly the safest bet when the ground starts shaking, right?
That's putting it mildly.
The takeaway, don't put all your eggs in one basket, especially if that basket is precariously balanced on an earthquake fault line. Diversification, it's not just a buzzword, it's a lifesaver for your portfolio. But knowing to diversify and knowing what to diversify into are 2 different things, right? So let's get into the specifics. What kinds of investments does the source actually recommend?
Well, remember, it's looking back from a century ago, so the investment landscape was a little different.
Okay, time capsule investing. Take us back.
We're talking railroad bonds, which back then were considered incredibly reliable.
Railroad bonds, huh? Sounds like something out of a history book.
They were a big deal. And, they were seen as safe because they were backed by tangible assets, the railroads themselves, and they were highly convertible, meaning you could sell them pretty easily if you needed to cash out quickly.
Okay, starting to see the appeal, but I'm guessing there's more to the story.
Always. The source dives into this concept of the basis of an investment.
Basis.
Okay, it's not just about the interest rate. You got to consider things like what were the prevailing interest rates at the time the bond was issued? How long until the bond matures? It's about looking at the bigger picture.
So even back then, it was about more than just, oh, that interest rate sounds good, I'm in.
Way more to it.
Due diligence, it never goes out of style. Now let's talk about something a bit more relatable: real estate. I'm guessing a century ago, people were just as obsessed with owning property as we are today.
Oh, absolutely. Real estate, it was seen as this stable investment, something tangible, something you could see and touch. It offered a decent rate of return, too. But this source, it doesn't shy away from pointing out the downsides.
Oh, like what?
Liquidity, or rather, the lack thereof. Real estate isn't exactly known for being easy to sell quickly if you need cash in a pinch. You can't just unload a house overnight.
So true. And I've got to imagine there were other challenges back then, too, right?
Absolutely. The source talks about these things called guaranteed mortgages.
Yeah.
Think of them as early versions of those mortgage-backed securities that got so much attention during the 2008 financial crisis.
Guaranteed mortgages. Those sound pretty enticing. What's the catch?
The idea was that a company would guarantee the mortgage payments, making them seem extra safe for investors.
Mhm.
But this source, it's like they were reading the future because they warn that those guarantees could be misleading.
There's always a catch.
Right.
Hmm.
You had to consider how stable the company doing the guaranteeing actually was. Were they going to be around to back up that guarantee if things went south?
So even back then, it was all about due diligence, really understanding the risks involved, not just getting dazzled by a fancy name. What else did those savvy investors a century ago put their money into?
Well, this was the era of the Industrial Revolution, right?
Mhm.
Factories popping up everywhere, new technologies emerging.
A time of massive change.
Exactly. And with that came industrial bonds, a way to invest in all that growth. But, and this is a big but, this source stresses the importance of carefully evaluating those companies before jumping in.
Makes sense. You don't want to invest in a company that's about to become obsolete. So what did investors need to watch out for?
The source, it really digs into the financials, like how much cash did these companies have on hand, what were their overall earnings, and crucially, what was the quality of their management?
A competent captain is just as important in business as on a ship.
Right. You need someone at the helm who can navigate those choppy waters. Now, remember we were talking about public utilities earlier.
Those essential services.
Well, back then, electricity and gas, they were still relatively new.
Essential, but probably a wild ride for investors.
You got it. The source really hammers home the importance of those early franchises, the agreements that gave these utility companies the right to operate.
Because a company without the legal right to do business is about as useful as a screen door on a submarine, right?
Exactly. And they also highlight the need to look at operating expenses, any political factors that might be at play.
Makes sense. I mean, government regulations, even just public opinion, can really make or break a utility company. So careful analysis, it was key even back then. We've covered railroads, real estate, industrial companies, even those early utilities. What else?
Well, how about something a bit more stable? Let's talk about municipal bonds.
Ah, those government-backed bonds. They always sound so reliable. Were they considered safe investments back then, too?
They were considered very safe. After all, they were backed by the taxing power of the city or town issuing them. But even with something as seemingly straightforward as a government bond, there were nuances.
Okay, I'm intrigued. Tell us more.
This source, it actually distinguishes between active and inactive municipals.
Active versus inactive. What's the difference?
Think of active municipals as those issued by larger, usually more financially stable cities. They're easier to trade, kind of like finding a buyer for a popular car.
Quick sale.
Exactly. Now, those inactive ones, those were often from smaller towns, or maybe they just didn't change hands very often. And if you needed to cash out quickly, you might be stuck with those inactive municipals for a while.
So even with something as seemingly straightforward as a government bond, liquidity, that ability to buy and sell easily, it was still a factor.
It's always a factor. Liquidity is king, right?
It seems to be. All right, we've covered a lot of ground here, but I've saved the best for last. Let's talk about stocks. Were they the hot topic a century ago that they are today?
The source definitely acknowledges that the stock market was heating up. But here's a key difference from today. The lines between what constituted a stock and bond weren't always so clear-cut back then.
Oh, interesting. So the financial world was a bit wilder back then.
A little bit, yeah. But even amidst all that, they do mention a particular type of stock that was considered to have a lot of growth potential. Bank and trust company stocks.
Interesting. Why those specifically?
They were seen as being very closely tied to the overall health of the economy. When businesses were booming, banks typically thrived.
Riding the wave of economic prosperity. But those stocks, they weren't without their risks, right?
Of course not. The source stresses that even back then, you had to carefully evaluate the bank's financial health, its management team, and how well it could weather those inevitable economic storms.
So even a century ago, it was all about doing your homework, understanding the risks, and making informed decisions. Some things never change. But how did those investments actually perform? We'll get into that and more right after this quick break.
All right, so we're back and ready to dive into the exciting world of dot market forces.
Because as much as we like to think we have control over our investments, those external factors can really throw a curveball, right?
Absolutely. And this source, it's fascinating because it lays out this relationship between interest rates and how well businesses are doing, almost like a seesaw.
A seesaw. Okay, I'm visualizing it.
On one side, you've got interest rates, and on the other, you've got business conditions, the overall health of the economy. And these two, they're constantly pushing and pulling on the value of your investments.
Okay, so it's all about balance, but how does that actually play out in the real world? Like, give me an example.
Okay, let's say interest rates are low, which normally would boost those investment prices. But let's also say that businesses, they're not looking so hot. Maybe there are whispers of a recession and investors are getting nervous.
Uncertain times, yeah, I can see how that would make people jittery.
Exactly. Now, remember those high-grade bonds we talked about? Those super reliable ones like municipal bonds?
The one's backed by the city's ability to collect taxes, right? That's pretty rock solid.
Exactly. Those are the ones that, in uncertain times, investors flock to because they still promise a return, even if it's small, and they're incredibly safe. So their prices might actually go up, even when other parts of the market are struggling.
It's like finding a safe haven during a storm, only the safe haven is a really reliable bond.
That's a great way to put it. Now, on the flip side, imagine those riskier investments, those low-grade bonds. If investors are worried about the economy, they're going to be less likely to gamble on something that's already a bit of a question mark.
So even if interest rates are low, a company's perceived stability or lack thereof really comes into play.
Big time. And then you've got those middle-of-the-road investments, things like our railroad bonds. They might kind of hover there in limbo. The low interest rates are trying to push them up, but those shaky business conditions are trying to pull them down.
It's a financial tug of war.
Right. This source is really emphasizing that you can't just focus on individual investments. You got to understand those big-picture economic trends.
So how do we do that? How do we become economic whisperers?
Well, the source talks about these credit cycles, which might sound intimidating, but they're actually pretty intuitive.
Okay, break it down for me.
Imagine a pendulum swinging back and forth. When times are good, credit is easy to get. Interest rates are low, people are borrowing, businesses are expanding, the economy is humming along. But eventually, that easy credit, it starts to create inflation. And that's when those central banks, they have to step in and raise interest rates to kind of cool things down.
So the party's over.
Right. Suddenly, borrowing's more expensive, people start to tighten their belts, the economy slows down, and it's this cycle, this boom and bust that's been going on for centuries.
And this book argues that understanding those cycles, knowing where we are within a cycle, it's key to making smart investment choices. It's like knowing when to plant your seeds and when to harvest, right? But how do we tell which way the pendulum is swinging?
It takes a bit of observation, a bit of analysis. The source points out that typically, after a crisis, after a downturn, things start to loosen up. Credit becomes more available, interest rates drop, and that tends to be a good time to buy because prices are generally lower. But as the economy recovers, as people get more confident, well, those rates, they start to creep back up.
And that's when we need to be extra careful.
Exactly. Those rising interest rates, they can be a sign that the music is about to stop, that the party's winding down.
So no more FOMO investing, huh?
Not if you're in it for the long haul. It's about recognizing that these cycles exist, that what goes up must come down.
Okay, I get it. But the real world, it's messy, right? It's not always as simple as a pendulum swinging back and forth. What else can throw these cycles off?
Oh, you're absolutely right. This source, it even mentions things like wars, natural disasters, those unforeseen events that can suddenly make capital scarce, disrupt those economic patterns. Remember that fire insurance company we talked about?
Oh, yeah, poor guys. One big earthquake, and their whole investment strategy was toast.
Exactly.
Yeah.
It just goes to show that even the most well-thought-out plans can be affected by those external factors, those things that are completely outside of our control.
So staying informed is key. But knowing what we know now, how did these different types of investments actually perform during those historical cycles? Let's start with those sturdy, high-grade bonds.
Remember, these bonds, they're less tied to how businesses are doing and more sensitive to changes in interest rates. So historically, when those interest rates dropped, especially after a downturn, these bonds, they soared. Everyone wanted that guaranteed return, even if it was small.
But when rates went back up,
Their prices would typically decline. See, bonds have a fixed interest rate, so when newer bonds are being offered with those higher rates as older bonds, well, they're not as attractive anymore.
it's like trying to sell a first-generation smartphone when the latest model just hit the market, right?
Okay, so what about those middle-of-the-road bonds, our railroad bonds, for example? How did they fare? Those were the ones that were influenced by both interest rates, A&D business conditions, so their performance could be a bit more unpredictable. When the economy was strong, they often did really well, but as soon as things started to slow down
Investors would get a little nervous.
a little bit, they'd start to jump ship, worried about losing their money.
Ugh.
Those rising interest rates would make those bonds less attractive, and the fear of a recession, well, it just made investors more risk-averse.
Makes sense. So then there were those more speculative investments, the low-grade bonds, the ones that were already a bit of a gamble.
Right. Those were highly sensitive to those credit cycles we were talking about. When the economy was booming, they could really skyrocket in price.
High risk, high reward, right. But what about when those good times inevitably came to an end?
Well, those bonds, they were often the first to plummet in price. They were just more vulnerable to defaults, to those economic downturns. They were a bit of a roller coaster ride.
I bet. Now, what about those bank and trust company stocks, the ones that were tied to the overall health of the economy?
Historically, they tended to follow those economic cycles quite closely. When businesses were doing well, those banks, they flourished. But then, when things took a downturn,
They took a hit right along with everyone else.
it's all connected. It all circles back to this idea that we've been talking about. Understanding those broader market forces, doing your due diligence, not putting all your eggs in one basket.
Diversification, the name of the game. This source really hammered that home, didn't it? But how has that strategy held up over time? Is it still relevant in today's market?
Well, the evidence is pretty clear. A well-diversified portfolio, it's like having a safety net for your investments. Even if one area of your portfolio takes a hit, the others might hold steady or even grow.
So we're aiming for that balanced breakfast of investments, not just a sugar rush in one area.
Exactly. Now, while this source is a goldmine of information from a century ago, I'm really curious to hear your thoughts on something it keeps coming back to: the basis of an investment.
Yeah, that's a great point. We're going to take a quick break, but when we come back, we're going to unpack that concept of basis and see how it applies to today's market, which, let's face it, is a whole different beast. You know, that idea of basis we were talking about before we break, it really got me thinking.
It's a fundamental concept, isn't it?
It is, and it seems like it's more relevant than ever today, even if the way we talk about investing has changed.
100 years ago, they didn't have algorithms spitting out buy and sell recommendations every millisecond.
Right, but even with all the fancy tools and technology we have now, it still boils down to understanding what something is truly worth, not just its price tag at this very moment.
It's like buying a house. You wouldn't just look at the asking price, would you?
Definitely not.
You'd consider the location, the condition, how long you plan to live there. All those things factor into its actual value.
And in the stock market today, that basis, it might include understanding a company's long-term strategy, how they stack up against their competitors, even how they're managing things like their environmental impact, factors that weren't as big a deal a century ago.
Yeah, it's a whole new ballgame in many ways. And that's actually something this old guide touches on. It talks about how even back then, the legal rules around stocks and bonds were constantly evolving.
And boy, have they evolved.
Trying to keep up with all the regulations, the new investment strategies, it's a full-time job.
It really is, but that's why that emphasis on staying informed, it never gets old. Whether it's poring over a company's financial statements like we talked about with those industrial bonds, or just keeping up with those ever-changing regulations, knowledge, it's truly powerful. It's what helps us make those informed decisions, right?
Absolutely.
So let's talk about those informed decisions, particularly when it comes to evaluating a company's financial health. What are some key indicators investors today should be looking at?
It's like giving a company a financial checkup.
Mm-hmm.
One of the first things I look at is the debt-to-equity ratio.
Okay, debt to equity, and remind us again what that tells us.
Basically, it shows you how much a company relies on borrowed money versus its own funds.
So, a high debt load, that could be a red flag.
It can be.
Mm.
Now, it's not always a bad thing, but it's definitely something to dig into. Then you've got the current ratio, which measures a company's ability to pay its short-term bills. Can they keep the lights on, basically?
You don't want to invest in a company that's about to go dark What else?
Profitability, of course, is key. We're looking at metrics like net income margin, return on equity, to see how efficiently a company generates profits. It's not just about how much money they're making, but how well they're managing it.
Are they being smart with their money?
Exactly. And finally, you can't forget about the leadership. A company's only as good as its management team.
That's where those human factors come into play.
It's huge.
Experience, integrity, vision, all those qualities that are hard to quantify, but they make a huge difference in a company's success.
It's about looking beyond the numbers, understanding who's at the helm, their track record. Can they navigate those inevitable challenges?
It's like assembling a team of all-stars. Only these all-stars are running companies, not shooting hoops.
Love that analogy. Now, let's bring it back to those bigger economic forces we were discussing. Remember those credit cycles, those swings between easy and tight credit?
Like a financial pendulum.
Exactly. Even with all the changes in the past century, those fundamental forces, they're still shaping our economy today.
So how are those credit cycles playing out in today's world? Because we've got global markets now, lightning fast transactions. It's a whole new ballgame, right?
It is more complex, but those cycles, they haven't gone away. Think
Really?
about it. When credit's easily available, interest rates are low, businesses are eager to borrow to expand, it's like a party.
Everyone's feeling good, the music's playing.
Exactly. But eventually, that easy money, it leads to inflation, and that's when the central banks, they step in to raise interest rates, to cool things down a bit, the music slows down, people start to head home.
The party's over. So it's about recognizing those shifts in the economic music, knowing when to ride that wave of growth and when to maybe step off the dance floor for a bit.
You've got it. And that's where understanding those historical patterns, seeing how different investments have performed during those cycles, it can give you an edge.
It's like having a map, even if the terrain has changed a bit over the years. And you know, as we wrap up this deep dive into the world of investing, I want to circle back to something this century-old guide really emphasized: aligning your investments with your own personal needs and goals. Which seems so simple, but in today's world, with all the options, all the noise, where do we even begin?
It can feel overwhelming, right? But it all starts with self-awareness, understanding your financial situation, how much risk you can handle, your time horizon, what are you actually saving for?
So it's a personal journey as much as a financial one.
Absolutely. It's about asking yourself those tough questions and being honest about the answers. What am I really hoping to achieve? How much risk can I stomach? And it's not a one-time thing either. Your needs will change over time, so revisiting your strategy, maybe with a financial advisor, it's a good idea.
Like a financial checkup, making sure your investments are still aligned with your life goals.
Precisely. The big takeaway here, the thing I really hope our listeners remember, is that investing, it's not just about picking stocks or bonds. It's about understanding yourself, understanding the financial landscape, and making choices that align with your vision of the future.
It's about taking control of your financial well-being, making those informed decisions, and building the future you want. So, as we wrap up this deep dive, we want to hear from you. What resonated with you? What investment strategy are you most curious about? Share your thoughts, your questions, your aha moments with us. And until next time, keep those minds sharp and those portfolios balanced.